will real estate market look like in 2024? Let's bring in Frank Sorrentino, ConnectOne Bank Chairman and CEO. ConnectOne is a commercial bank in New York and New Jersey, the metro area. It's good to see you, Frank. Welcome.
Great to be back. Thank you.
So what do you see right now for housing activity since we've seen mortgage rates come down?
You know, certainly there's an uptick in mortgage applications today as interest rates have come down a bit. But I have to tell you, 2023 was a very robust year for housing starts, for home builders, for apartment builders, and for people graduating into new homes and buying and building new homes. It was a pretty robust year.
So it didn't really slow down as much as you would think with an 8% mortgage rate.
You know, on the construction side, we all have to remember, you know, our housing stock in the United States is woefully undersupplied. And so for the past probably a decade, we've been at least 1 million homes short in the United States. That includes apartments and single-family homes. So builders have really been taking advantage and constructing in neighborhoods. As you know, it takes a long time to get something approved and to get something with a shovel-ready project in the ground and then deliver it. And so there's just a steady stream of folks that are looking for new product. The housing stock that exists is aging quite a bit. So it's actually a pretty good time for home builders and contractors today.
When you talk about, or when you hear people talk about this coming crisis for regional banks, what is generally your response to that? I will also say I'm looking at a headline on the the Wall Street Journal this morning. Says banking crisis plays out at America's smallest lenders. Now, they're talking mostly about rural community banks and their giant underwater bond portfolios. You're not a rural community bank, obviously, but I'm sure you have perspective on both of those topics.
Look, ConnectOne Bank here in the New York metro market has really stayed true to what banking needs to be for its community, and that is we take in deposits and we make loans. We don't have any esoteric products, and we certainly continue to build through our deposits for our clients, servicing our communities, and making loans in those communities. So a lot of those issues really don't impact, you know, what we're doing here in the New York metro market. And I would say that's true for quite a few of the banks in the country. There are some that have lopsided securities portfolios, and I guess that bears to watch. I think the reduction in interest rates over the last few weeks probably helped a lot of those out. And so crisis may be a strong word for what's happening in the banking industry today. Let's not forget, it's banks that provide, you know, the liquidity and the funding and the capability for business to do what it does here and make the United States what it is today.
But there were all sorts of worries after that regional bank string of failures about a credit crunch, that banks like yours wouldn't be giving out loans and would surely change their posture. What's happening on the loan side and access to liquidity for businesses and individuals?
So I think what really needs to be focused on is what is the Federal Reserve doing? The Federal Reserve is doing two things. They've increased short-term interest rates, which obviously dampens some economic activity, makes people think about what the cost of funding is for various types of projects or lending opportunities or whatever. And so that just dramatically slows down the economy all by itself. But secondly, and probably more importantly, is what the Fed is doing with its balance sheet. And the reduction of the size of its balance sheet directly impacts the banking industry and the amount of liquidity that's in the system, in the banking system, which in turn slows down lending. Now, I believe both of those things are exactly what the Fed has planned. They wanted to bring inflation under control. They wanted to slow the economy down, and they wanted to impute a normalized rate of return, interest, or cost of money in the economy as we go through this next phase. That all represented probably for 2023 one of the slowest growth years for lending. But I do think we will see an increase in lending as we move into 2024. Liquidity is beginning to come back into the market. GDP is up. Everyone has a job. People are feeling good about the economy. So I do think when we look ahead to 2024, we're going to see a better time.
Well, that's encouraging. Frank, thank you for joining us with that outlook.